Hello everyone and welcome back to our valuation series. Have you ever wondered how a company decides to undertake a project or if the investment is worth the large capital expenditure made? Investment banks, when considering to acquire a company, needs to determine whether or not the company will benefit in the long run. Even people who buy real estate as an investment, when they lease out with the hope that it will turn a profit. All these questions can be answered by valuing the assets using the discounted cash flow model. Discounted cash flow model is a type of financial model that determines whether the investment is worthwhile based on its discounting its future cash flows. The core principle behind this is that rupees 100 is worth more today than rupees 100 a year after. What does this mean?
Imagine you went to McDonald's and ordered something worth rupees 100. If you go 1 year later, those same things you ordered for rupees 100 would be little bit more expensive, maybe 105 or 106 rupees.
This happens because of variety of reasons, but the major reason is inflation. Getting back to discounted cash flow, there are three components taken into consideration while calculating discounted cash flow. First, cash flow. It is the earnings or revenue from the assets acquired or the projects undertaken. Dividends from the share, income from the sale of products or services all form a part of cash flow. Second, number of periods. This is the number of years that the cash flow is expected to occur for the project or the investment. Third, discount rate. The discount rate is the weighted average cost of capital. It is used to bring the future cost at the present value. This cost is usually the interest rate on the loan payment or dividends on the bond. So let's understand the discounted cash flow model with the help of a practical example.
Suppose a company wants to undertake a project costing 15 lakhs. The project is expected to last for 5 years and the cost of capital is 10%. We will assume the cost of capital to be the discount rate. The cash flows from the project are as follows. First year 1 lakh, second year 4 lakhs, third year 5 lakhs, fourth year 6 lakh and fifth year 7 lakhs. So using this future cash flows and the discounted rate, the yearly discounted cash flows rounded up are as follows. 90,909, second year 3,30,579, third year 3,75,657, fourth year 4,09,808 and fifth year 4,34,645. Adding these discounted values, we get rupees 16,41,598.
While comparing the initial value with the discounted value, we can see that the discounted value exceeds the initial value, which means that the project is profitable. While discounted cash flow model is exceptionally good for predicting whether or not to invest, there are few limitations. First, the cash flow numbers are estimates, not the actual numbers. So, for it to be useful, we need to predict the numbers correctly. Second, the future cash flows can be affected by a variety of factors such as status of the economy, competition, and other unforeseen threats. So, while DCF does have its drawbacks, for the investments where the cash flows are fixed, such as bonds, DCF is clearly extremely helpful for the investors.
If you have any questions or feedbacks on our video, please leave them in the comments below and don't forget to like, share and subscribe to our channel for more such videos. Till then, stay tuned for our next video on valuation series.